Welcome back. So, in this course which we are going to talk about introduction to commercial banking and fintech, this course first two lectures we covered the macro side of the banking sector and some kind of interdependence. We also looked at some of the key concepts, theories related to the banking sector. We looked at also the financial development growth dimension, King and Levine we discussed. In this lecture, which is about the money in the economy. So, from this lecture onwards, we can say that we are getting into the formal understanding of the commercial banking, and also to what extent which all variables at macro level which is determined by the central bank plays important role. So, in the economy, if you see at aggregate level, there are different regulating the financial market. For example, if you just think about the Indian setup, Indian economy setup. So, here you have, so if I take into account the regulators, so the first is the RBI, all the commercial banking, all its activities NBFCs, you will have the cooperatives and all other except the institutions under NABARD are regulated by RBI. So, what is the role of RBI? RBI controls the money. So, its role is controlling inflation. So, price stability, we use the term price stability is its key objective. But once we are talking about price stability, so they have to do it through some mechanism. So, a mechanism could be in terms of controlling the money supply or increasing the policy rate, which is repo rate. So, in this lecture, what is the purpose? The purpose is that we will first look at types of money. So, when we define types of money, how many types of money we have, what is the definition? Where money is the facilitator, it helps in. So, it is a, so if you just try to focus on the functions of money. So, what is the function of money? First is that it is a medium of exchange, store of value. You can say that if you are keeping 1 lakh rupees worth of money in the bank, then you can say that it has the store of value, right. The another dimension that we look at. So, first is the medium of exchange, store of value, then third is the it's having the legal value, which means that in terms of the legal tender. So, one function is that the money can also get into the exchange of, or you can say it facilitates, which is related with one transactions, right. So, these are, so primarily if you look at, we have two types of functions. First is the medium exchange, which is directly or indirectly linked here, and second is the store of value. Now, if you look beyond money, so how do you define money? So, if I have to write money in how many ways? So, we have cash, we have deposits, we have fixed deposits, we have fixed deposits, then here we have the you can say the post office deposits, right. We also have some kind of plastic money, right. So, money, if you ask the proper definition of money, that how it is defined. So, money is defined based on its ready to, or you can say based on its liquidity. So, what is the liquidity here? Ready to transact. So, how quickly money can help you buy a new product. So, ready to buy, transact, right. So, this is what here. So, in terms of liquidity, if you see, coming back to this, cash has the most liquidity, followed by you can say short term deposits, then long term deposits. So, less than 1 year, greater than 1 year. All these have lot of role to play, and these variables are directly linked with the commercial banking that we want to discuss here. So, in this particular session, we will try to touch upon these dimensions and try to find out that how these dimensions are important. Now, we focus on the money supply measures in India. So, RBI defines money supply into the classification of money supply, or you can say clubbing of money, is into 4 aggregates that we have. First is called as the M1, which is the narrow money but highly liquid. Second is M2, which is high powered money, it consists of liquidity and others, and M3 is the you can say broad money that we often define, and M4 is the broadest, which means that it covers all. But in terms of liquidity, accessibility, how quickly you can access, and stability, how stable are these. So, you can say that in terms of stability, M1 has the most important characteristics, M3 and M4 are relatively less. So, this is where it is important to note. We will be now getting into the formal definition of M1, M2, what it consists of. So, M1 is the narrow money. What is the narrow money? So, it consists of currency with public, it consists of demand deposit with banks. So, whatever money that you deposit, so currency, it also includes coins, right. You can also, to some extent, you can say debit card also you can include. Demand deposits with bank, and then here we have other deposits with RBI. What is the other deposits with RBI? Other deposits with RBI implies that we are talking about the money kept with the central bank by the various agencies. So, embassies in India, they also keep money, Exim Bank, and there are other financial institutions, they keep their money, ready money I am talking about, not the. So, various institutions also keep the money. So, they have account with RBI. A lot of financial institutions abroad, they keep money with the RBI, they get a rate of interest on that. So, that kind of. So, in order to have the high liquidity, if suppose big organizations, even the World Bank and all others, if they want to operate in India, so they keep their liquid asset with the RBI, and whenever they want, they can get it. So, this is where other deposits with RBI comes in. Demand deposits with banks, whatever consumer deposits money with the bank. So, you have 500 rupees you deposit. So, this we call it as the deposits through fractional banking. I will explain that in subsequent lectures, maybe after 2 to 3 sessions. So, deposits with, we call it as fractional banking. Right. So, this is what here we have. So, notes and coins with the public, this first. Demand deposits with banks, for example, current accounts, overdrafting facility, and all those you can see. But demand deposit in the sense that you can just keep money with the bank, and bank gives you rate of interest. So, for the bank, it is some kind of liability, right. So, this is what we often find. and if you just sum this up, this aggregate. So, why we call it aggregate? Because M1 consists of currency with public, demand deposits with banks, and other deposits with RBI. So, this is where. So, M1, as you can see here in the title, it is a narrow money. So, this is very important. Narrow money is highly liquid, and because of that we call that as a. So, in terms of scope, it has less relevance, because you can buy goods and services, you can keep money with the bank, but since it is mostly in the current account, so it will be mostly related with narrowing the scope of usage of money. So, this is where it is called. Once the money is held by the bank for a larger or longer period, then it has a role, and then we add the term not narrow but broad, because bank will be also using that money to make money out of it. So, M1, so M2 is nothing but here M2 that you are seeing, it is nothing but M1 plus post office savings. So, M2 is equal to nothing but M1 plus post office savings deposit. Components are all items of M1. Then here we have the postal savings. So, savings account balances, and if you just so post office, so in India the post offices also accept the deposits in the form of different schemes that they offer, and nowadays they have started also operating as a bank, proper bank. So, if you have account and if you are saving your money with the post office, then you are supposed to earn higher rate of or you will be earning rate of interest on that. So, whatever money that is being kept in the post office savings account, it will be called as M2, which is called as high powered money or something, because it will simply M1 is already liquid, and then post office savings, this money is with the post offices. So, they will be also lending to somebody to make money. So, this is where it is important. Now, for policy making purposes, if you read economic survey and if you try to understand that what it mentions about. So, economic survey always deals with broad money. What is the meaning of broad money? So, broad money includes your M1 that we have, currency with the public, demand deposits with banks, and other deposits with RBI. So, M1 includes that, plus time deposits with banks. So, in time deposits you can think about some kind of fixed deposits that you have with the bank. So, since this money is going to be with the bank for a longer period, so they can multiply, they can lend to somebody after meeting the compliance of reserves with RBI. So, this is where it is important. So, in most of these, so here you have fixed, term, recurring if you are doing with banks. So, this is what time deposits imply. Numerical example is this. So, M3 is nothing but it is the broad money that here we have. So, M4 is the broadest aggregate. So, M4 is M3 plus total post office deposits. So, savings plus time. So, M4 is equal to M3, which means that broad money. So, this is M4, you can say broadest. So, M1 was the narrow, then M2 you can say the mid kind of. So, it is also called high powered. M3 onwards we saw a proper broad money definition, and M4 became the broadest. So, M3 is the currency and demand and time deposits, and all post office deposits that we have, savings plus term. So, in this what is the difference? So, here we are not just including here only with the bank. So, in M3 we just target the bank, right, this, but here in M4 we are also adding the total post office deposits, both savings plus time deposits that here we have. But in for policy making, as I mentioned, in economic survey and all the major documents, government documents that we read, we find that broad money is often used as the major one as compared to the M4, and M3 is highly popular. If you just try or if you just give a glance of it, which is about, so here in this particular slide I have summarized the based on the usage. So, M1, which is currency with public, demand deposits with banks, and other deposits with RBI, it is highly liquid. So, that I have mentioned already. Then M2, which is M1 plus post office saving deposits, it adds to the postal savings, which is still in rural segments. The post office savings are crucial and they play important role. Then here we have M3, which is M1 plus bank time deposits. So, broad money is this, and M4 is the broadest. Now, let us understand how these monetary aggregates play important role in driving or increasing or decreasing the money supply, or even driving the inflation in the economy. So, we will try to calculate, as I mentioned, that money multiplier concept here. In undergrad courses, these concepts are very much important because these concepts are fundamental. Those who are in masters will be also touching upon some of the characteristics of money multiplier, so that you can analyze and accept and maybe use that for understanding the credit creation by banks and how banks make money. Or you can say that we can also talk about fractional banking, which play important role. So, here we have B, which is so broad money that here we have, or you can say base money. So, this is what is the M1. So, base money is nothing but currency plus reserves that banks are supposed to keep, right. And then here we know that your currency and deposits, it is nothing but the M is the broad money, C is the currency, and D is the deposits, right. And we know that the monetary base, the very basic M1 kind of scenario, it is nothing but C plus R. So, this is with the, so how base money converts into broad money. So, this is how we have. So, currency and reserves that here we have in the base money, it gets into the broad money through currency plus demand deposits. If I have to take into account money multiplier, so here we say that here if you just write, so your M is nothing but, or you can say M is equal to small m b, and if you solve for M, then it becomes M by B. So, this is what here we write. So, M is equal to M into B. So, your broad money is nothing but what is you are keeping that as a fraction, or you can say factor, multiplied by the base money, and this factor is nothing but what we call it as the money multiplier later. Now, here we are assuming that C is equal to C upon D, cash upon deposit. So, currency deposit ratio we are calculating, and second is the reserve deposit ratio. If reserve is higher, right, your RRR is higher with respect to D, then of course, you are going to keep more money with the in reserve. As a result, you will have less availability. So, money supply will be disrupted. This we will explain in a moment. So, as I mentioned that your broad money is nothing but currency plus demand deposits, and your base money is nothing but currency plus reserves. So, if I divide this by both side by D, so it becomes what, C upon D. So, here you can say, so we are saying that M is equal to M by B, right. So, what is M? M is C plus D, and B is what, C plus R. So, here we are saying that divide both side by D. So, here we have D upon D upon C upon D plus R upon D. So, what you have here, it gets cancelled. So, here what we have, C upon D plus 1. So, if it is cancelled, then we have C upon D plus 1 upon C upon D plus R upon D, and here we have 1 plus, finally we write that 1 plus C, and here a small c that you are seeing, it is nothing but it is C upon D, and a small c that you are seeing, it is again the C upon D. That RR, the required reserve that you are seeing, it is with respect to deposit. So, this is what here we have, right. And finally, if you see the expression is coming 1 plus C upon C plus RR, but remember this is dealing with commercial banking, right. So, if C is equal to 0, then M is equal to nothing but 1 plus RR. So, if you are not keeping money with yourself, it goes to the banking sector, then your money multiplier, which is M, is determined by 1 upon RR, right. So, if it is 1 upon, if their RR is 10%, right, then 1 upon 0.10 is nothing but 10. So, this will be your money supply or money multiplier value that here, right. And here RR that here we have, it includes both required reserves plus excess reserves. So, sometime when banks are finding or banks do not keep money with the banks are not able to lend whole money. For example, you deposited 100 rupees with the bank, the reserve requirement is 10%. So, it means that bank will have 90 rupees to lend, 10 rupees they will have to keep with RBI. So, this is with RBI, right. 90 rupees they are lending and they find that they are able to lend only 80 rupees. So, 10 rupees they can keep that in excess reserve with RBI, but on this they will not get any rate of interest, but they can lend fully 90 rupees, but if they are not able to lend due to some reasons, due to macroeconomic scenario or any other thing, then they can easily go for having keeping this money somewhere. So, this is what excess reserves can be added to RR. So, RR is nothing but, you can say RR is nothing but required reserves plus excess reserves. This is where it is important. So, this is what here R that here we have is nothing but the required reserves plus excess reserves, right. So, this is what here. So, excess reserves and the money multiplier concept. So, R upon D is nothing but R required plus R excess upon D, right. So, if you just put the value, if RR is equal to 0.078, if CRR is 4%, so RR is 0.04. If we just substitute on this 1 plus C upon C plus RR, and if C is equal to value is 0.10. So, 1 plus 0.10 upon, so here you can say 1 upon 0.1 plus 0.04, what comes out to be, it is 7.86. And similarly, if it is 6%, you have the CRR plus excess reserves, which is 2%. So, if it is 6%, so 1 plus 0.10 upon 0.10 plus 0.06. So, it is 6.88%. This is what here we have, right. So, this is what we get. So, as we find that it is going higher and higher with the reserve requirement, right. So, if excess reserves is higher, then of course, we are finding that money multiplier value will be lower, because if denominator is higher, then of course, if C is not changing and if denominator is higher, overall money multiplier will be lower, and if the R is lower, then multiplier value will be higher. So, this is what here we have. And if C is equal to 0, so no currency drain, which means that no one is keeping money. If you are earning 10,000, it means that you are keeping all the money in the bank and you do not keep at home, but if you are keeping, suppose you get the salary of 15,000 rupees, you withdraw 15,000 rupees and keep it at home, you do not keep with the bank, then this will not work. So, this is where, so C is equal to 0, no currency drain is this. Bank A hold reserve, so this is what here we have, and lends 1 minus RR fraction, which means that if you have 100 rupees as I mentioned, and if it is 0.10, so 0.90 you have the money available. So, 1 minus, you can say 1 minus 0.10, so 0.90 here you have for lending, right. So, loan becomes a deposit in bank B, which gives RR, and if you see, this is what the credit creation of the banking sector looks like. At the end, what we have, 1 upon RR. So, this is what here we have, which C is greater than 0, which means that some people are keeping money in the bank, then it lowers the money multiplier. So, this is where it is important. If you just look at the comparative statics of M, then we can say that MCRR is equal to nothing but 1 plus C upon. So, if you just see the change in money multiplier due to change in the required reserve, then it appears to be negative. Higher the reserves, lower is the money multiplier. So, if you just take the partial derivative of with respect to RR, 1 plus C upon C plus RR. So, this comes out to 1 plus C upon C plus RR, and this is where it is very important. del m upon del c is equal to minus 1 minus r r upon c plus r r. So, it is just with respect to c, right. So, 1 minus r r, if you solve, then this is the value that we get, which means that what is the crucial point here? Crucial point is this negative sign. It is showing inverse relationship. So, as we have the change in currency, it leads to change in money multiplier. Due to change in currency, it is also having the negative effect. Similarly, change in the money multiplier due to change in the rate of or required reserve, then it is also having negative. It means that higher reserve ratio, a smaller multiplier, and higher currency preference, you are keeping all the money at home, you are not depositing, then also it has the a smaller multiplier. And if you just see the example that if c is equal to 10 and r is equal to 0.5, we are getting 7.33. and if the base money, you want to see that how much the broad money, when we are having the base money of 5,000 crore, assuming 7.33 as a money multiplier, then it comes out to be your broad money will be around 36,650. So, when you read the economic survey, you find that why they mention about this broad money, because broad money is nothing but money multiplier, which is the ratio of the, you can say, broad money upon the base money, right. So, this is so money multiplier is nothing but delta m upon delta b. So, you can see that given the base money, that here we have 5,000, we are getting with money multiplier of 7.33, we are getting 36,650 crore, which means that a small base increase magnifies into the larger broad money. And if you read the economic survey mentions about it. So, in economic survey they have discussed the money multiplier. So, m adjusted for reverse repo. So, you can see that the blue line, which is the broad money relative to base money. So, this is what here we have, and then adjusted for reverse repo. Reverse repo I will come in the next session, but just to give you a brief background, there are two types of rates. One is the repo and second is the reverse repo. Reverse repo when banks keep money with the central bank, repo when they borrow money from the central bank. So, adjusted for reverse repo, so whatever money multiplier that we have, whatever money is with the RBI, if banks are lending money to RBI, then if we are adjusting for that, whatever money with the RBI, then money multiplier, you can see that m adjusted multiplier is lower than the money multiplier, because we are adjusting for the reverse repo, and this is where it looks like. So, in the current scenario, it shows that it is all about the liquidity absorption, and this is what it mentions about. So, I have picked it up from the economic survey, and so overall what comes out that in this particular session, what we learnt about the different types of monetary aggregates, which are very crucial from the exam perspective, from the practical side perspective, from anywhere you go, you will be asked about monetary aggregates. So, always remember the narrow money, broad money, broadest money. So, M1 is the narrow money, M3 is the broad money, M4 is the broadest money, and M2 is the high powered money, or you can say because it includes the demand deposits. How money multiplier plays important role. So, reserve ratio plays important role. If reserve ratios are higher, banks are keeping more money with themselves and they are not lending it, and if the reserve ratios are lower, banks are having more money to lend. So, it creates more liquidity in the economy. So, with this background, I am stopping it here and I appreciate your attention. Thank you so much.